Welcome to The Deep Dive, your shortcut to being well-informed. We cut through the noise to bring you the essential insights, the strategic takeaways from the most important reports and calls. Today, we're diving deep into the second quarter 2025 earnings call from Moelis Company. Now, they're a key player, obviously, in the advisory space. And this wasn't just a routine update call. It felt more like a snapshot, really, of a firm navigating these evolving markets with, well, remarkable agility. And they're executing on some pretty ambitious growth plans. So for anyone tracking the high-stakes world of investment banking, this deep dive should offer some compelling signals, a clear look maybe at where the industry might be heading.
Exactly right. Moelis Company didn't just meet expectations this quarter. I mean, they significantly outshone them. And management offered a notably clear outlook, didn't they? On their strategic priorities, market sentiment. We've taken, a stack of their reports, the earnings call transcript itself, our own research notes, to really distill what truly matters for you.
Okay, let's get right into those headline numbers then. How did Moelis Company truly perform in Q2? What did it signal?
They absolutely crushed it. Adjusted earnings per share came in at an impressive 53 cents.
53 cents. Okay, and the consensus was what? Around
32 cents. Yeah. So yeah, well above the estimate. But it wasn't just EPS. Revenue also saw a really strong beat, hit $365.4 million.
Wow, $365 million. That's
a whopping 38% year-over-year increase.
Wow.
And get this, it made it their highest Q2 revenue on record.
Highest ever for Q2. And consensus was much lower, you said?
Oh, yeah. The consensus range was like $269 million up to maybe $282 million. So they sailed right past that.
Okay, those are some seriously impressive beats, particularly that revenue growth. It suggests they're not just, riding a rising tide, maybe grabbing market share. What did the other key financial metrics tell us about the quality of this performance?
Good question. Yeah, you're right to ask about the quality. The adjusted pre-tax margin nearly doubled year over year, climbed to 17.6%, up from 8.3%.
Doubled. That's a powerful indicator. Efficiency, pricing power, maybe?
Exactly. Their compensation ratio, that was accrued at 69%, consistent with the previous quarter. And non-comp expenses were kept pretty tight, 14.4% of revenue. But what's even more striking, I think, is their balance sheet. Very strong. $474.9 million in cash and short-term investments.
Okay.
And critically, no debt or goodwill.
No debt or goodwill.
They also maintain their quarterly dividend, 65 cents per share.
A strong foundation indeed.
Yeah.
Especially that absence of debt and goodwill in, this kind of market. How does that capital structure uniquely position them compared to peers, particularly if market volatility, continues?
Oh, it's a huge differentiator. I mean, in a market where some firms might be stretched thin, Moelis has incredible flexibility. No debt means, less sensitivity to rising interest rates for one, and more capacity to act opportunistically.
Right, like strategic hires or...
Exactly. Strategic investments in new talent or returning capital to shareholders. It gives them a very strong defensive and offensive posture.
Okay. So with those impressive numbers, that robust financial position established, the natural question becomes, what's truly fueling this performance? And how is management planning to sustain it in this evolving transaction environment? What was their take on the current state of deal making?
Well, what's fascinating here is the resilience they highlighted, especially through that recent market volatility. Management used a phrase, temporary disruption, to describe a period around Liberation Day back in early April.
Right, I remember that. Things seemed to pause.
Yeah, new transactions were largely paused for about 5, maybe 6 weeks. But they quickly emphasized that activity accelerated significantly from mid-May onwards. And crucially, their new business origination remained healthy, with the pipeline reaching near record levels.
Near record levels, okay.
Yeah. So it wasn't a slow crawl back. It sounds more like a sprint.
So if Liberation Day was just a speed bump, it sounds like the market quickly put its foot back on the gas. What specifically is driving this rapid rebound in deal making, and what kind of deals are we actually seeing?
Absolutely. The rebound seems pretty broad-based, driven by both strategic clients, corporate buyers and private equity sponsors. These clients are actively looking to execute transactions. Why? Well, largely due to ongoing technological disruption, pushing companies to adapt. And also, there's this pressing need for private equity sponsors to recycle capital, get it out of older funds into new investments.
Makes sense.
Ken Moelis, the founder, he actually noted the market is improving almost daily. And he expects a steadily improving market, not like a big bang of M&A activity post-Labor Day.
Right. Less of a, fireworks display and more of a slow, steady sunrise. I like that analogy.
Yeah, exactly.
And that steadily improving market rather than a Big bang. Does that suggest maybe a more nuanced approach is needed by advisory firms, perhaps favoring quality over sheer volume and deal pursuit? And how does Moelis position itself for that kind of environment?
That's a sharp observation. It absolutely favors firms with those deep relationships, specialized expertise, because you're working on more complex, often larger strategic deals rather than just a flood of smaller ones. And this leads us right into one of Moelis's key strategic plays, their aggressive build-out of the private capital advisory business, PCA.
PCA.
This raises an important question about their long-term growth vectors, doesn't it? They are intensely focused on scaling this segment, viewing it as a major growth driver.
So tell us more about this PCA segment. It sounds like it's becoming a central pillar for them. What kind of talent are they bringing in, and what specific areas are they targeting within private capital?
They're making a very deliberate move here. They added 3 leading PCA bankers just in Q2, and they're specifically targeting what's known as secondaries.
Okay, secondaries, where existing LPs sell their stakes.
Exactly. Sell their stakes in a PE fund to another investor, and also continuation vehicles.
Continuation vehicles, refreshing my memory. That's when a GP sets up a new fund for assets from an older one.
Precisely. To hold assets from an older fund, basically extending their investment horizon. They anticipate this whole PCA business becoming maybe a couple $100 million or more revenue opportunity.
A couple $100 million, wow.
Yeah, potentially establishing it as a third or fourth leg for the firm, right alongside their traditional M&A and restructuring businesses.
You mentioned these PCA hires are expected to contribute faster than typical M&A bankers. Now that's a bold claim. What's the underlying mechanism here? What makes them different? And what's the strategic advantage for Moelis?
It's a critical point for their investment thesis, yeah. Management explained that these PCA hires, they become productive much faster because they're immediately integrated into ongoing dialogues with sponsors.
So they're plugging into existing relationships.
Exactly. They're not starting from scratch. They're bringing new expertise, new options to existing clients. Plus, the focus on secondaries and continuation vehicles, that inherently offers a quicker time to market compared to primary fundraising.
Which can take ages, right?
Months, sometimes years. Yeah. And critically, it complements their existing M&A business. Offers more holistic solutions to private equity firms, makes Moelis, an even more indispensable partner.
So it sounds like this isn't just about diversification. It feels like they're anticipating a structural shift in private equity, where firms increasingly need these agile solutions to manage older funds, recycle capital, and Moelis is carving out that sweet spot.
Precisely. It's a proactive move, addressing evolving client needs in a really high-growth area. And speaking of long-term vision, we also heard about a significant leadership transition during the call.
Yes, a very important one. Tell us about the succession plan. What does it mean for the firm's direction?
Indeed. Founder Ken Moelis, he'll transition to executive chair. That's effective October 1st, 2025. And co-founder Navid Mahmoodzadegan, he's taking over as CEO.
Okay.
It's described as a methodical transition, carefully planned, they say, to ensure client coverage continuity, a smooth handover. And Mahmoodzadegan emphasized a focus on the same core principles going forward.
Like what?
Things like investing in high total addressable markets. TAMs basically focusing on sectors or client needs with big future revenue potential. Attracting difference makers in lateral hiring, fostering that collaborative culture they're known for, and developing internal talent. So it signals continuity, not some radical shift.
Got it. Continuity. So with such a strong financial showing, clear strategic priorities, the elephant in the room is often, what does a company do with its capital? How is Moelis planning to deploy that significant cash balance, particularly regarding shareholder returns?
Yeah, management was very direct about this. The board is actively discussing the deployment of their, quote, excess capital. Share buybacks are explicitly expected to play more prominently going forward. That's alongside the maintained quarterly dividend.
Okay, so more buybacks.
Yeah, Ken Moelis was quite candid. He said, and I'm quoting again, "We recognize that we probably have more excess capital than we want or need."
Wow, that's pretty blunt.
It's a strong signal, right? Confidence in future cash generation and a commitment to optimizing shareholder value.
So they're investing heavily in PCA, but also signaling increased buybacks. How are they managing overall expenses with this aggressive investment strategy? Are there guardrails in place?
Yes, they've set clear operating guardrails. The compensation expense ratio remains accrued at 69%. Pretty consistent, predictable. Non-compensation expenses, they're projected to grow approximately 15% year over year for the full fiscal year.
Okay, 15% growth on non-comp.
And the corporate tax rate is accrued around 29.5%. Management indicated that while they're aggressive in PCA, the overall pace of investment in hiring might feel similar to previous periods. They're focusing on strategic hires in those high opportunity areas rather than just, growth for growth's sake. It feels like a targeted, disciplined investment approach.
Makes sense. One final point on the business mix. What's the trend for restructuring activity in this environment, especially with the market showing such resilience?
That's interesting too. Restructuring activity has actually trended flattish to slightly down this year.
Flattish to down, okay.
And they expect it to continue that way. Why? Well, largely due to what they described as a tidal wave of liquidity in private credit, and also the strong M&A market we just discussed, marginal companies, the ones that might otherwise face restructuring.
They're getting bought or refinanced instead.
Exactly. They're now more likely to be acquired or refinanced. So that shifts activity from pure restructuring towards capital markets and M&A opportunities, which of course benefits Moelis' other segments.
Right, feeds back into their strengths. So putting it all together, what does this mean for you, the investor, looking at Moelis Company in this evolving landscape?
Well, if we connect this to the bigger picture, Moelis' Q2 performance and their forward guidance, it paints a picture of a firm strategically leveraging market tailwinds and leveraging its exceptional financial position. That aggressive PCA build-out positions them to capture growth in this rapidly evolving private capital landscape, and it directly complements their core M&A business.
Yeah.
This isn't just about riding a wave. It feels like they're actively shaping where that wave goes for their clients.
It certainly sounds like they're not just leaning into areas with significant long-term potential, but are actively, maybe even defining those growth vectors for themselves.
Exactly. And look at the broader market. The rebound in global M&A deal value that was up double digits in the first half of 2025, even though deal counts were kind of muted,
Right, bigger deals.
suggests a shift towards larger, more complex transactions. And that directly benefits advisory firms like Moelis that specialize in those high-value strategic mandates. And then you layer on their capital allocation strategy, particularly that increased focus on buybacks. It just signals strong management confidence in future cash flow and a clear commitment to shareholder returns. This firm is making deliberate moves that, well, could translate into significant value.
All right. Makes sense. It's time now for our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea based on today's deep dive. What have you got for us?
Okay. Given Moelis' rock-solid balance sheet, those explicit plans for excess capital deployment through buybacks, and the anticipated ramp-up of the PCA business, here's a thought. Consider a long position in Moelis Company ticker MC, but with a covered call strategy overlaid.
A covered call. Okay, tell us more. For listeners who might not be fluent in options, could you maybe quickly break down what a covered call actually entails and why it specifically fits Moelis' current profile?
Sure, happy to. So a covered call is where you buy the underlying stock, in this case, MC shares, and then you simultaneously sell call options against those shares, usually out of the money calls, maybe with a 6 to 9 month expiry.
Okay, buy the stock, sell the calls.
Right. Now, the outrageous but plausible angle here comes from the thesis that, yes, the stock saw a modest bump post-earnings, but maybe the full impact of sustained deal conversion and those formalized aggressive buybacks isn't fully priced in yet. The calls you sell, they would cap your upside if there's a parabolic, explosive rally.
It limits the home run potential.
Exactly. But in a steadily improving market like the one management described, the premium income you get from selling those calls could significantly enhance your total return. It's a way to participate in their growth story, generate some income along the way, and subtly hedge against a scenario of more moderate, albeit consistent growth, rather than, say, an overnight moonshot.
Interesting angle. Generate income while waiting for that value to potentially unlock.
That's the idea.
Okay, that's it for another deep dive. Today, we unpacked Moelis Company's Q2 2025 earnings. We highlighted their strong financial performance, that very deliberate strategic expansion into private capital advisory, and a clear path forward for capital allocation.
Yeah, it was a robust quarter. Definitely reflects a firm that's not just well-positioned for what they see as a steadily improving market, but one that's actively making moves to define its future growth. And remember, everyone, this information is for educational purposes only. It is definitely not financial advice.
We hope this deep dive into Moelis Company has given you some valuable insights, a clearer picture maybe of the strategic plays unfolding in the advisory space. What aspects of Moelis' strategy or performance stood out most to you? We always love hearing your thoughts. Until next time, stay informed and keep learning.